I'm speaking with Dean Rubino, CEO of KPC Private Funds. Dean, good to see you.
Good to see you too, Chris. Thanks for having me.
Dean, can you share your professional journey from education to career path to how and why you came to your current role?
Sure. So I was born and raised in Brooklyn before it was trendy. Spent most of my life there and then went to college in Connecticut, undergrad at Trinity College, which was great. And coming out of Trinity College, I was hired into Merrill Lynch's Global Systems and Technology program, which was their undergraduate training program for grooming future leaders in technology. Now, mind you, this is kind of before there was an internet, so technology meant something different back then, but there were some lessons learned that still apply to today. But in my training class of 84 people, I was the one that wanted to really be a bond trader and not a coder or a computer programmer. So I left Merrill after about almost 4 years and went to business school at Columbia, which when I graduated, I did a brief stint in government bond trading, which morphed into prop trading. But I learned a lot about managing risk there on a trading desk. And that prop trading eventually morphed into very tax efficient allocations to external managers with the bank's internal prop capital. And that's where I got my first exposure. And this is in the late 90s, early 2000s to what we now call private funds, but hedge funds, CTAs, private equity funds, and started to learn about diligence. From there, I joined a startup, which was really a fund of funds, so kind of furthering that diligence theme in my career. And we went from zero to half a billion in about 3 years. Of course, this was 20 plus years ago, so half a billion meant a little bit more than it maybe does today. And then I was recruited by Hamilton Lane to run a fund of funds for them. And we took that fund of funds from a billion to almost 2 billion in assets. I was CEO and CIO in about 2 years, a little under, and sold it in June of 2008 in probably one of my better examples of luck being preferable to smarts. But again, learned a lot about diligence and just some M&A and managing a company there, and then went to another asset management firm in New York, which was a little more eclectic. We were incubating hedge funds. We had a fund of funds business, but much more retail oriented as opposed to pension and sovereign wealth fund oriented like Hamilton Lane was. And we also were very involved as SPAC sponsors in the SPAC space. So there I got my first exposure to financial advisors who were really the constituency or investor base of our fund of funds at that shop. And so if you kind of tie that all together, my career went from technology to risk management to a little bit of structuring to a lot of diligence and then learning about the financial advisor world. And that's been the last 30 or so years for me on the street.
Awesome, very good. Thank you. Now, what is a current professional focus of yours, and why are you working on that in particular?
Good question. So it's actually a culmination of those skill sets I highlighted from my career, right? So the technology, the risk management, the structuring, the diligence, and the working with financial advisors. So what we recognized several years ago is that financial advisors were going independent in droves, leaving the big wirehouses. And there were some really good structural fundamental reasons for this. And I think that's why we've seen that trend continue, if not snowball. The challenge for the financial advisors is while there were a lot of turnkey solutions for them on the traditional investment side and on the compliance side and on the content side, there really wasn't the same available to them when it came to hedge funds, private equity funds, or private investments in general. For example, pre-IPO stock, which we consider to be a private investment alongside a hedge fund or a private equity fund. So we sought out to build a solution for wealth advisors, which is tech-driven, involves a lot of structuring, at least on the back end for us, will help manage risk and educate advisors on the private investment channel, but solves for many of their pain points. Things like a cumbersome onboarding process for their clients, things like multiple K1s for multiple investments, things like high minimums for various funds, things like being unable to access pre-IPO stock because you can't get it on statement at the custodian that you use as an independent advisor. And I can go on and on and on with the logistical issues like that. But at the end of the day, someone has to be prudent on the investment side as well. And there are a lot of hurdles there. I jokingly say that the financial advisors allocate their time very efficiently. They have 95 to 100% of their clients' assets invested in stocks, bonds, and ETFs, and that's where they spend 95 to 100% of their time. But if they want to make a 5 or 10% allocation to private funds, private investments, you shouldn't expect them to spend more than 10% of their time there. So on the investment side, there's a lot of pain points as well that need to be resolved for them. So we're here to resolve all of those pain points and make it easy. And that's what our focus has been for the last few years. And it's really an amalgamation of all the skills I've developed over those last few decades on Wall Street.
Dean, that is very informative, and I think something that a lot of financial advisors and RIA leaders should look into. So thank you for your time.
Thanks for having me. Take care, Chris.